in order to itemize your taxes, and I've talked about this on some previous episodes, you have to have deductions that are higher than the standard deduction. So the standard deduction for an individual is $12,400 for 2020, and it's $24,800 for a married couple filing jointly. So what are the items that count to be able to itemize? Well, one of them is mortgage interest, another is state and local tax, and another is charitable contributions, and then another is medical expenses that exceed 7.5% of your adjusted gross income.
Are you ready for a successful retirement? We're addressing the topics facing today's retirees. Welcome to Retire with Ryan. Now here's your host, Ryan Morrissey.
Welcome back. Hope your 2021 is off to a good start. I wanted to talk this week about charitable donations and the best way to make them so that in addition to helping out the charity, you could also help yourself out by taking a tax deduction with these donations and contributions. So there's really 4 ways that you can make a charitable contribution and take advantage of that on your taxes. And I'd like to go through those 4 ways. And way number 1 is that thanks to the COVID relief bill that came out at the beginning of this year for 2021 and also 2020, you could donate and deduct up to $300 in cash contributions to a qualified charity. And that is per person. So if you're married, you and your spouse could each donate up to $300 to one charity, to multiple charities, and you can take that as what's known as an above-the-line deduction. You could have done this for 2022, but unless you did it in the 2020 calendar year, unfortunately, you can't go backwards and do that. You really just would be able to focus on doing this in 2021. Now, you could make a greater contribution or donation to a charity than that of the $300 per person, but unfortunately, that's what you're limited to deducting. And there is a possibility of donating more than that and deducting it, but we'll have to talk about that as we get into the other ways. So that's pretty straightforward. Way number 2 is that you donate property. That would be like used furniture, clothing, things that are laying around your house that are no longer of value to you. You donate them to a charity, and you're then able to possibly deduct the current value of that donation. So let's just say, for example, you donate a t-shirt that you paid $40 for, but it's used, so it's only worth $10 now. Well, you'd be able to deduct $10 of the value of that. Now, to be able to deduct this, however, you need to be able to itemize your taxes. And many of us, as a result of the TCJA Tax Act that was passed a few years back, where most of us are not able to itemize our taxes. Many of us are taking the standard deduction. Now, why is that? It's because in order to itemize your taxes, and I've talked about this on some previous episodes, you have to have deductions that are higher than the standard deduction. So the standard deduction for an individual is $12,400 for 2020, and it's $24,800 for a married couple filing jointly. So what are the items that count to be able to itemize? Well, one of them is mortgage interest, another is state and local tax, and another is charitable contributions, and then another is medical expenses that exceed 7.5% of your adjusted gross income. With this change that happened a few years back, unfortunately, there's a cap on mortgage interest, how much you can deduct, and there's also a cap on state and local tax up to $10,000. So for myself, many people that live in Connecticut, we have both property tax and state income tax. Chances are, if you're working, that's higher than $10,000 that you pay into that, but you're limited to $10,000, so you can't itemize. So if you're making these charitable donations of used property, things around the house you no longer need, chances are you're going to do it anyway, but most likely you're not going to be able to deduct this on your taxes because you're not able to itemize. So that brings us to way number 3. And this has a few components to it. This also has to do with donating cash to a qualifying charity and or property that is property that's appreciated, not something that's used. This would be either stocks or real estate or art or gold, commodities, things that you've bought that have a gain in value. So depending on the charity type and also depending on what you're donating, there's a limit to how much you could deduct. So let's go through those. So the first category is where you're donating cash to what's known as a first category organization, or as the IRS describes as an IRS or IRC Section 170B1A charity, which is commonly known as a 50% limit organization. So these types of charities are usually churches, other houses of worship, educational institutions, hospitals, federal and state or local governments, and publicly supported charities for charitable, religious, scientific, literary, educational purposes, or for the prevention of cruelty to children or animals. And with these charities, due to the TCJA Jobs Act of 2017, it temporarily increased the AGI limit that you can donate to these charities from 50% to 60%. So what that means is that, let's say, you're a taxpayer and you make $200,000 of adjusted gross income for 2021. Normally, you could donate and you up to 50% of your adjusted gross income, or $100,000, you could make as a cash donation to one of these charities, and you could deduct that whole amount on your taxes. And because of the change in 2017, you're able to deduct 60% of that. So you could donate up to $120,000, and that would reduce your adjusted gross income dollar for dollar. And because now you're donating more than the standard deduction, you're able to deduct all of this. So when you donate more than the standard deduction, or when you donate enough where your other itemized deductions that you're allowed are more than the standard deduction, that's really where this can benefit you. If you just donate $10,000 and your other itemized deductions are still less than the standard deduction, then you're not actually benefiting from the donation. So that's where, when we get to option number 4, you might want to think about where you're donating the money from. So we're talking about cash donations to those 50% limit organizations. And until the Tax and Jobs Reconciliation Act expires in 2025, this is going to be, it's now a 60% limit. It's possible that the new administration, the Biden administration, may change the tax rates, and there's talk that they might cap this at 28%. But until then, if you're very charitably inclined, you could donate a large amount of cash and significantly reduce your adjusted gross income in the year that you donate, or you have the option to carry forward and use these donations up for 5 years. You don't have to decide that when you make the donation. You have until when you file your taxes to decide how you're going to spread out these donations. So the next within this option 3 would be cash donations to other charitable organizations. In other words, ones that aren't 50% limit organizations. You're able to deduct 30% of your adjusted gross income for that year. So we use the same example. You have adjusted gross income of $200,000. You could deduct 30% of that in cash donations. So you could donate up to $60,000 and deduct that whole amount against your taxable income for 2021. If you donate more than that, if you donate $100,000 of cash, then you can carry forward that remaining amount just like before. So if you donate $100,000 with $200,000 AGI, you could deduct that remaining $40,000 the following year. And so depending on the charity that you donate to, you can look up which type of charity this is if you're going to be donating a large amount to figure out how you're able, or how much of that you're able to deduct. Next would be if you're contributing property where you had a capital gain on. So if you have a stock that you've owned for a while and you've been holding off selling it because you don't want to pay the taxes, well, another option is that you can donate that stock without selling it to the charitable organization. They would then be able to sell it, not pay any taxes on it. They get the proceeds from the sale, and you get the deduction for the donation that you've made. The difference with that is that you're limited to 30% of your adjusted gross income. That's the maximum deduction you're allowed. So again, back to our same example, you have a $200,000 adjusted gross income. You donate stock that is currently worth $100,000 and you paid $20,000 for the stock. So you don't have to pay tax on an $80,000 gain. You get to deduct up to 30% of your AGI. So you deduct $60,000 for this year. So you still have a remaining $40,000. That $40,000 then gets used up the following year or over the next 5 years. That then brings us to option number 4 within this option number 3, you could say, which is donating, again, property that you've had capital gain on to other charitable organizations, where instead of getting that full 30% deduction on your AGI, you're limited to 20%. So again, using that same example, you donate $100,000 of stock and you have a $200,000 adjusted gross income. You're able to deduct 20% of that. So $40,000 could be used this year, and then the following years you could use up the remaining. Now you also have the ability, you could donate property that you didn't make a gain on. Maybe you bought a stock and for whatever reason, it hasn't gone up and you want to donate that. You could also donate that, and you'd only be able to deduct the fair market value of the stock, not what you paid for it. So in that situation, you'd probably be better off selling that stock. It's stock that you have a loss on. Let's just say, for example, you bought a stock for $20,000 and it's worth $15,000. You could donate that stock $15,000 and take that potentially as a deduction if you qualified. But the other option is you could sell that stock. Now you have a $5,000 loss. You could actually take that loss on your taxes, and you could also then donate the cash proceeds from the sale. So that is another option as well with that, if you have an asset you want to donate that you don't have a gain on. Now, to really blow your mind here, as far as deducting these donations, also as a result of the CARES Act, you have the ability to donate and deduct up to 100% of your adjusted gross income for a cash contribution made to one of those qualifying charities, those 50% charities. So we go back to our same example. You have $200,000 adjusted gross income. You have $200,000 of cash that you want to donate to one of these qualifying charities. You donate the whole $200,000 in 2021. Now you have zero income for the year, so you owe zero in taxes. So that is the ability just for this year. It was for last year and this year to donate 100% of your adjusted gross income to a qualifying organization. And however, because we still have that 5-year period that we could do that, this probably doesn't make a lot of sense, because the reason to take advantage of this, other than the charitable benefit that you get, is to lower your taxes. And you really want to be lowering your taxes when you're in a higher tax bracket. If you find yourself in a tax bracket higher than the 12% bracket, so our first tax bracket for everyone is 10%, then it's 12%. And for married couples, that starts from about $20,000 up to about $80,000 of taxable income. Once you go above that, now you're into the 22% tax bracket. So 22% and higher is really where these charitable donations make sense to help you save taxes. So in that situation, you might not want to take the whole $200,000 deduction in one tax year. You'd probably want to spread it out so that if your income was going to be $200,000 the following years, that way it would help you for that income that's above 12% to save tax on that. Otherwise, you're not really helping yourself out by getting your income all the way down to zero in any one year. It sounds good, right? It's great to pay no tax, but you might be able to pay less tax collectively by taking advantage of this donation over time, as far as how you choose to deduct it on your taxes. So if you are making these charitable donations, make sure that you keep a close eye on your tax return, that your tax return is being itemized if you do qualify for it. And a lot of times this gets missed on tax returns I've seen. So keep an eye out for that if you're making these. One other thing that I should mention is that part of as I said earlier, the reason of the benefit that you get from this is by lowering your taxes. Another thing that could help you for this year is that if you have a small business or you have self-employed business income, you could qualify for what's known as a qualified business income deduction, which is about a 20% reduction on your self-employed income. So if you earned $100,000, instead of paying tax on $100,000, you'd be paying tax on $80,000. So that's a big advantage. And in order to do that, however, there are income limitations that your adjusted gross income has to be under a certain limit. So if you find yourself in that situation, a way around that, one way is making retirement plan contributions, as we talked about before in the podcast where we talked about options for self-employed individuals, retirement plan options. But another way is you make a charitable donation, and then that also reduces your AGI. And so that leads us to our fourth option, which probably for a lot of my listeners, especially those people that are in retirement, that are over age 72, should and could take advantage of. And that's where you make what's known as a qualified charitable distribution, or a QCD. So if you remember, when you reach 72, it used to be 70 and a half, but it's now 72. You have to take a certain amount of money out of your retirement accounts. That's known as required minimum distribution. There's a schedule based on each year that how much you have to take out. So let's just say, for example, that you had to take out a $20,000 required minimum distribution this year. If you remember, in 2020, they were waived. There was no requirement. You still could have taken money out, but you didn't have to take a certain amount out. So in 2021, they resumed, and let's just say you have to take $20,000 out, and you normally donate $2,000 to your church that you attend. But since the changes to the TCJ Act in 2017, you can't itemize that because you don't have enough itemized deductions. Well, instead of giving a cash donation out of your checking account, you give them part of your required minimum distribution. You could give them part of that $20,000. You make it directly as a donation to the charity. And what that does is that saves you paying tax on $2,000. So instead of paying tax on $20,000 distribution, you're now only paying tax on a $18,000 distribution. So if you assume, let's just assume you're in a 25% tax bracket combined between your federal and state tax to make it easy, that $2,000 amount that you're donating to the charity, we take 25% of that. That's $500. And that's what you save in taxes by making this donation to the charity. It's just as good as making a cash donation because it has the same effect. It's lowering your adjusted gross income dollar for dollar, just like a cash contribution would, provided that you could itemize. And as we discussed, for many people, once you donate over $300 per person, unless it's a significant amount more than that, then you're not able to itemize. So some of the key things here to be aware of is that, number one, to take advantage of this, you have to be over 72. This has to be part of your required minimum distribution. So if you're younger than that, then you can't do this. The only exception for that would be if you inherited an IRA from a non-spouse and you have to take out a certain amount from that inherited IRA, you could donate part of that each year without any regard to what age you are. Secondly, this has to come out by the Rmd Deadline, which is the end of the year. So by December 31st of 2021, or any year that you do this going forward, the money has to come out. It has to be transferred directly from your IRA account to the charity. Most IRA custodians, I mentioned that I use TD Ameritrade Institutional, they have a form that you fill out where they then mail the check directly to the charity, or they can send the money to them sometimes electronically. If you take the money first and then you write the check to them, it doesn't qualify. So make sure that you don't first take your required minimum distribution and then decide later on that you want to do this because you've screwed up the process by doing that. You also can do this up to $100,000 per year. It used to be that every year this would have to be decided upon by Congress, but thanks to a tax act that passed in 2015, this is now a permanent, it's called the PATH Act. This is a permanent part of the Internal Revenue Code. So you can do this going forward unless somehow this was changed, but it's $100,000 per person. So that means a husband and wife could donate $100,000 each, $200,000 of your RMD could be donated to the charity. Now I mentioned $100,000. If your RMD is less than that, obviously you'd then be limited to whatever your RMD was, but it could be multiple charities. You just have to make sure that it's a qualifying charity, and certain ones are not eligible, including donor-advised funds, private foundations, certain supporting organizations, and you also are not allowed to receive any benefit in return from the charity. For example, if your donation covers the cost of you playing in a charitable golf tournament, then you wouldn't qualify for the donation. The type of retirement accounts that are eligible are traditional IRAs, inherited IRAs, SEP IRAs, only inactive ones, and simple IRAs that are only inactive. So 401k, 457 plan, 403b plan, those plans don't qualify. So that is a reason maybe why you would want to roll those plans over to a traditional IRA to take advantage of this. You can do this for a Roth. However, Roth IRAs, if you go back and listen to my episode on Roth IRAs, they don't have required minimum distribution. So there'd be no reason to do this from a Roth IRA. You'd really want to do this from the traditional IRA or inherited IRA that you have. And at the end of the year, you get a 1099 that shows, how much that you've received, and that's how you know what is reportable on your taxes for that year. So I hope you found this episode helpful on the 4 ways that you can make a charitable contribution and also receive a tax benefit from it. If you're enjoying these podcasts, please subscribe on your favorite podcast app, such as Apple Podcasts. And if you can, leave a 5-star review. That's always appreciated. And as a reminder, if you're interested in getting help with your own retirement plan, or you know someone who needs help, you can attend one of my webinars that are starting. They begin February 25th. They're all being done online, so can be attended from the comfort of your home. And if you go to retirewithryan.com or you go to morseawealthmanagement.com, you'll see a pop-up that shows you where you can go to register for that class. I hope you have a wonderful week, and I look forward to talking with you next Wednesday. Take care.
You should consult a financial advisor familiar with your specific circumstances before you make any financial decisions. Nothing in this broadcast constitutes a solicitation for the sale or purchase of any securities. Any mention of rates of return are historical or hypothetical in nature and are not a guarantee of future returns. Ryan Morrissey, CFP, is an investment advisor representative of Morrissey Wealth Management, LLC, a registered investment advisor.